Good morning and welcome everybody. I'm Martin Yells, partner in the Banking and Finance team at Taylor Wessing, and welcome to the latest in our series of lending-focused seminars. This time coming to you for the first time as a webinar format, so hopefully this will work well. This morning I'm pleased to be joined by 5 other members of the Taylor Wessing team. In terms of our running order, which should be reflected in the slides you'll see on your screen, we'll be starting with Larica Joubert and Kate Bowden, and they'll be talking to us all about litigation funding and some of the structuring issues that arise there. We'll then pass to Fiona Cody and Louis Dufall, who will talk about equity margin financings. And lastly, and by no means least, we'll finish with Al Watson, who will be talking to us about mixed-use developments. We've got about 45 minutes running order for the 3 slots. There's an opportunity for some Q&A at the end. You should have a Q&A box on your screens, so if you tap away, we'll circle back with any answers at the end, or possibly follow up afterwards if there's not enough time. At the end of the webinar, you should also have a feedback survey box on your screen, so please do provide feedback both on the content that you've heard today and also any other areas of interest that you'd like to hear of at future seminars and or webinars. So without further delay, I will hand over to Larica and Kate.
Thank you, Martin. As mentioned by Martin, my name is Larica Joubert and I'm a partner in the Banking and Finance team. Today I will, together with my associate Kate Bowden, be discussing what we like to describe as a new asset class, namely litigation funding. We are seeing a lot of activity in this space and it's very much the flavour of the month. Today we will briefly be looking at what it is and why it exists, the types of claims favoured by litigation funders, typical lending structures, and then finally, we'll just flag a few key issues to consider if you are considering investing in a litigation funder. Kate, can you please explain what we mean when we say litigation funding and also why it exists?
Of course. At its most basic, litigation funding is essentially just an uninterested third party meeting the costs, which will principally be legal fees, of one of the parties to a litigation. And that funder will receive an upside from the damages of that party, if they're successful, either as a percentage of the recovery, essentially a multiple of the investment, or a combination of the two. In our experience, it's often coupled with after the event, or ATE insurance, which is paid out at the end to cover the costs, possibly of both parties, if the claimant is unsuccessful. And often the premium will be funded by the funder as well. In terms of why litigation funding exists, I don't think anyone listening will be surprised to hear that litigation is incredibly expensive, and as it offers a combination of limited recourse financing and insurance, it allows a claimant to pursue a meritorious claim that they might not otherwise have been able to afford. Essentially, it turns litigation into an asset that they can leverage, as opposed to a liability on their balance sheet. So that's why claimants are interested in funding, but we also see law firms as being active borrowers in this space. The length of some litigation cases, coupled with the trend for law firms to offer conditional fee agreements or damages-based arrangements, mean that law firms will require funding to meet their working capital and cash flow requirements during the course of a litigation. I think the existence of insurance companies who are specialising in this area and providing specific products that are complementary to litigation funding has also helped develop this area. So I suppose that's why there's a demand for litigation funding, but there's also a ready supply. It's becoming a very attractive proposition for investors. Even though it's a limited recourse form of financing, the return on a successful case can be huge, so typically anything from between 150% to 300% of the initial investment. As it's not linked to stock markets, it allows for risk diversification, and actually we often see that when markets are down, litigation increases. It's also a pretty stable market. So government policy and the approach of the courts has generally been positive towards the development of litigation financing, and it's increasingly recognised and supported. And I think most people will be aware that the English courts are a really popular area for big litigation cases, So there's a huge amount of work out there for people to invest in. Although there's a lot out there, not all cases will be suitable for litigation financing. And I think Larica will now just cover what are the key cases that people are looking at when they're coming to invest.
Thank you, Kate. As an investor, you have to obviously understand the asset class you're investing in, and therefore it is important to understand the litigation funder's business. As an investor, you are ultimately funding the provision of limited recourse loans to the litigation funder's clients. There are various different types of claims being funded by litigation funders in the market currently, and it will of course depend on the individual litigation funder's area of focus. For example, some litigation funders provide funding to individual claimants for clinical and medical negligence claims, whereas others fund claims against large institutional defendants and companies in respect of, for example, mortgage breaches and mis-selling. And some litigation funders also provide funding to corporates for meritorious claims. Another attractive area for investors is class actions, and we've actually previously advised a private equity house where they funded the ATE premium and expert witness costs in a very high-profile class action in the UK. As mentioned by Kate, in respect of each of these claims, the litigation funder can be funding various different parts of the costs, for example, the expert witness costs, the disbursements, and also the ATE premium. Just moving on to the typical lending structures we see in the market on slide 6. At the top of that structure, you'll see the lenders, and today's talk is very much focusing on that box where we're looking at the funding of the litigation funder. So at the top of the structure, you'll have a wide variety. As Kate mentioned, it's quite an active market, and there are actually quite a few participants at this level, and you'll have a wide variety of traditional banks, PE houses, and also other alternative lenders at the top providing funding to the litigation funders. Typically, we do see a combination of both debt and equity, although for the purposes of today's talk, we're only looking at the debt element, so therefore the slide does indicate secured loans flowing into the litigation funder. Depending on the litigation funder itself, it may have obviously different business models, and on the slide we look at two different models. The one model on the left-hand side being the model where the litigation funder actually funds the law firms directly. And as mentioned by Kate, there's actually quite a lot of law firms active in this space currently utilizing this funding made available by the litigation funders, and thereby obviously freeing up their balance sheet and some cash flow. Now those law firms then use that money, that funding, to obviously fund their ongoing costs, as obviously, as you can imagine, these litigious claims do run for quite a long period of time, and these law firms obviously use that to cover, for example, WIP and also other disbursement costs. On the other side of that structured chart, slightly different model where you have the litigation funder funding the claimants directly, and these claimants could actually be individuals, and Kate will come on to that later just to flag what you need to be aware of if that is the case. But even though the loan relationship between the litigation funder and the claimant, that's where the loan relationship sits. In practice, however, the litigation funder will actually advance the money to the law firm acting for the claimant. So the law firm will hold the money on an undertaking, and the law firm will then disperse and use that money for the permitted purpose. And obviously that's also a method of protecting the litigation funder's investment in that particular area. So ultimately, as an investor at the top of the structure, this just illustrates why it's important to understand obviously the underlying assets, and it's all obviously receivables. Clearly there are recoveries, and ultimately to the extent that the loans are repaid and the cases are successful, obviously the money flows up the chain, and you ultimately as the investor get repaid your secured loan right at the top of the structure. There are various issues one needs to be mindful of, and obviously some issues are more relevant for the one side of the structure and other issues are more relevant for the other side of the structure. That said, for the purposes of today's talk, Kate and I thought it probably made sense just to flag a few common issues which do actually come up in both structures. Kate, do you mind kicking off?
Absolutely. So there's obviously a few basics. If you're looking at funding a litigation funder, you'll be interested in what products they provide. Are they directly funding claimants, or are they funding law firms? If they're funding law firms, what sort of facilities are they making available to those law firms? So perhaps cost advance facilities or work and disbursement facilities. One of the things you'll need to look at carefully is there any relevant legislation or regulatory approvals required? There's the sort of typical FCA approvals that anyone in the sort of marketing financial products needs to hold. But if the funder is funding individual claimants or possibly law firms who are essentially sole practitioners, there might be Consumer Credit Act issues that you need to be aware of. I guess there's overarching points such as whether you've got the risk appetite. As mentioned, it's limited recourse financing and recovery is based entirely on a successful outcome of the underlying litigation. And you need to be aware that the tenor of funding might be relevant here. If it's a single claim that you're looking at investing in as opposed to a portfolio, it's an illiquid asset, and it can take years to make any kind of recovery. So you have to either be in it for the long term or be looking at volumes in this case. But I suppose the key from our perspective anyway is really careful due diligence, which is likely to be a more involved process than on other types of investments. Funders will typically drill down into underlying arrangements between the litigation funder and their clients, probably lock in templates, have them attached to the back of the loan agreement with any deviation from those templates requiring consent, be looking to ensure CCA and FCA regulatory compliance as mentioned, be looking at what security the funder is getting for their investments, taking a very careful look at the current loan portfolio, what their financial management practices like, how disciplined they are, what the ratio is between good debt, bad debt, current recovery ratios and portfolio performance. So really making sure that you're fully aware of what's going on in the business before you make the decision to invest.
Absolutely, I agree. Due diligence is key, and as mentioned before, as an investor, you do have to understand the underlying products, as that will ultimately assist you in determining the appropriate covenant package for the relevant litigation funder. For example, are you imposing a borrowing ratio, and at what level will that be set? And also just looking at the underlying loans, as Kate mentioned, the loans being made by the litigation funder to its clients. Will you actually be funding all of those loans, or will some loans be ineligible and therefore not funded by yourself? So it can get quite complicated, therefore it is important just to understand the business at the outset, and also just your risk appetite generally, eligibility criteria, and what are you actually looking to fund, and do you actually also want the litigation funder to have some skin in the game and, for example, only fund 80% of the litigation book, for example, as opposed to the full 100%. Other protections that is quite common for the litigation funder, well actually the funder of the litigation funder, the investor at the top of the structure. Obviously you are slightly removed, one level removed, but you do want monitoring rights, and that's quite common as an investor to be given certain monitoring rights, access to information, and all of this information, as you can imagine, if it's a large book of litigation cases and claims, it is quite information that can move quite quickly, and it's live information being live updated. So often we see portals being established and the investor having access to a portal to see live, when a claim, for example, is successful and if it's not successful. All of this obviously is a bit of a balancing act, because clearly you still need to give the litigation funder sufficient flexibility to run its business. The final point perhaps worth mentioning here is just cash flow control. As an investor, clearly you are very interested in how the litigation funder actually uses the money it recovers. Will it be reinvesting that money, and at what level? And then also there should be some restrictions just generally on, for example, that litigation funder incurring further indebtedness, and also restrictions on dividends. For example, you would want there to be complete freedom in relation to dividends while, for example, your debt remains outstanding. There are various other issues to consider as well, but to be honest, there are many different types of structures. We can't cover all of it, and your due diligence should, however, flush these issues out. Final thought, perhaps just to leave you with, is that the structures can become very complicated and highly structured, especially considering that you do have an equity element as well, which gets overlaid on top of the debt. And today's talk was just very much a high-level look at litigation funding generally, but also more from the perspective of the investor coming in at the top and investing in the litigation funder. And as Kate mentioned, different structures, obviously law firms versus claimants, and we've also included a link to one of the articles that Kate and I wrote on this, and it should be in the resource tab, where we looked at more specifically law firms and at the underlying products that they make available to their clients. So that might be interesting reading if you are interested in this particular asset class. Otherwise, we are obviously more than happy to assist you with this, so please do reach out to either Kate or I if you have any further questions in relation to this particular area. Thank you. And I will now be handing over to Fiona Cody and Lou Dufel.
Thank you, Larica. My name is Fiona Cody. I'm Senior Counsel in the Banking and Finance team, and I'm joined by Lou Dufel, who is a Senior Associate in our team. And we're hoping in the next few minutes to give you an overview of equity margin financing, which is a relatively bespoke product, but one which, used correctly, can offer some really significant opportunities for borrowers. To set the scene, at its most basic, an equity margin loan is a secured loan which is advanced against financial assets, often listed equities, where those financial assets are valued very regularly, often on a daily basis, and the borrower is obliged to ensure that there is a certain headroom maintained or a margin maintained between the difference in the value of the collateral and the value of its loan. In the next few minutes, we'll give you a quick outline as to this product, some of its key features, and briefly look at the pros and cons of this as a debt instrument and why it's more suited to certain borrowers than others. So, kicking off, what sorts of assets can be margined? I've already mentioned this is really financial assets, and very commonly it's listed equity securities, although more recently we have seen facilities looking at interests in shares in funds and other investment companies. But most traditionally this relates to listed equities. And there's a good reason for that, because there are two key features which collateral needs to have in order to be considered appropriate for equity margining. First of all, it needs to be highly liquid, and secondly, there needs to be price transparency. And therefore, not even all listed equities will necessarily be suitable. Lenders will often include, almost always include in their documents, requirements that there is a certain average daily trading volume of those assets, usually averaged out over between a 30 and a 90-day period. So they will want to see a sizable flow of trading in those assets, and there will need to be a clear referable price point for those assets. In the case of a listed equity, of course, that will be an exchange trading price at the end of each trading day. And in the case of more esoteric financial assets like fund shares, it may be based on information published by the funds regarding its own NAV, for example. But there needs to be some reference point for lenders to quickly and reliably value those assets. So what's the function of a margin finance loan? Why do people take on this debt? Most commonly, the purpose of this is to increase a market share in an equity, and therefore it's principally used for acquisitions of additional financial assets. Quite often you see it used where borrowers may have some sort of holding in a listed company that they want to increase, and by depositing the shares they do have together with the shares they propose to acquire, they can leverage their position and use far less of their own cash to acquire that new stake. That being said, it can simply be used as a liquidity tool, and there's a good example on the slide of that, because it allows the borrower to leverage those passive investments while still taking the dividend upside, the voting control, and any increase to the share price, but releasing cash in the interim. Louis, do you want to talk a little bit about sort of the market generally?
Yeah, so I guess historically, as you just sort of touched on, margin loans have been used as a sort of method for founders of companies to leverage their investment and release cash. We've maybe seen the market moving away from lending to individuals actually connected to the issue of the equities due to sort of greater reputational risk, where sort of mismanagement of the management of the issuer has caused the issuer share price to crash, and that's caused a default for the banks. Interestingly, the US actually has a retail market for margin loans made to individuals' portfolios of shares, but we're yet to see a sort of retail market develop in Europe. I mean, that might be because the interest rates are quite punchy, so 8-9%, but one would think that it's ripe for a sort of fintech application at a retail level in Europe and the UK. An interesting side to it from a legal point of view is the extent to which the margin shares can be used as eligible collateral for credit risk mitigation purposes. Obviously, from a bank's point of view, the last 10 years they're subject to ever more stringent capital adequacy regulations. To the extent to which they can improve their capital adequacy position by the security value of the shares being used for credit mitigation is obviously improve their position. Interestingly, in January this year, the PRA produced guidance saying that you're concerned at the number of UK banks where they were using margin sort of shares for this purpose, and a specific concern is where the creditworthiness of the borrower is materially dependent on the value of the collateral, and that in those scenarios that the collateral should not be used to mitigate the loss at the point of default. This is sort of particularly pertinent when we come on to look at the documentation structure, because in a typical margin loan structure, you're looking at an SPV borrower, where its only assets are the shares that are used as collateral. That might be more than one issuer's shares. It might be more than one listed company whose shares are in that pool of security assets. But often it's non-recourse finance, and the bank's only security assets are the equity securities. We do also see, I should add, that loans where they do have full recourse to the borrower. Often the shares and cash collateral are held by a separate custodian, which is quite often the same entity as the security agent or the lender, sitting with a different hat on. The facility, going over the documents, the facility agreement looks like a typical LMA facility agreement, and the kind of key differences that you'll see when you look at them are in the valuation mechanics for the shares, the margin call mechanics for posting collateral and answering margin calls, which Fiona will come on to look at, and the mandatory prepayment events, because a lot of them are sort of no fault of the borrower events of prepayment. There'll also be a pledge over the cash and the shares held by the custodian, and often there's a separate agreement between the security provider or the borrower and that custodian governing the terms of the custodianship. And a key point when negotiating documents is that, like with an account bank, there are prima facie conflicts and clashes between those terms of custodianship and the pledge agreement and the facility agreement. For example, the custodian often has its own right of pledge or lien over the shares and right of set-off, and it's key to get those waived when you are creating the security interest in the equity securities. There are difficulties, which I'm sure many of you are sort of will appreciate, with taking security over equities held in a clearing system. Crest actually has its own process, the clearing system Crest, for allowing a pledgor to retain title in the shares but transfer the shares into an account of a nominee or custodian, and therefore grant a security interest to the lender. We'll look more at the kind of default regime, but typically an enforcement method is actually the lender will use its power of sale, and they will undertake an accelerated book build to sell the shares as quickly as possible without sweeping the market. The lender will probably also have the right to appropriate the shares under the financial collateral arrangement regulations, but only obviously if the security document is classed as a security financial collateral arrangement, and there are certain difficulties with demonstrating you have sufficient control over the collateral that you can class as security financial collateral arrangement.
So we'll just now take you through, I think, which are the four kind of headline points to consider in margin financing that really distinguish this product from other types of borrowings, and particularly from balance sheet or corporate or leveraged finance, which takes a very different flavour. The most obvious sort of point of difference, and really the hallmark of a margin financing facility, is the capacity for a lender to make a margin call. And the circumstances in which they're able to do that is circumstances where the value of the collateral has dropped to a point where you have triggered a certain LTV, which is a ratio between the loan that's outstanding and the value of the collateral that's been posted. So at a certain point, there'll be a trigger threshold, a percentage, and in the event that the LTV it reaches that, then the lender will be entitled to, and in practice will, deliver a margin call notice to the borrower requiring that there is additional collateral posted in order to remedy that and to bring it down, usually to more than 10% below the trigger level. The time frame for that is in many respects interesting and often surprising for borrowers who undertake these facilities for the first time, in that they are very, very tight timelines. The facility agreement will specify actual times of day where certain cut-offs occur, and therefore there's always a note of caution regarding time zones. But what is very common in debt financing is for banks to say they have certain cut-off times, and then as the clock ticks closer to that time, it mysteriously moves to later in the afternoon. In margin financing facilities, that's not the case. These are real cut-off times, and therefore there is a risk for borrowers that they do need to be very alert to this process. As you can see here, the timeline is often just a couple of days. And what this sort of flushes out is two things in terms of what sorts of borrowers might want to think about this type of facility. First of all, it does require a borrower to have some sort of active, alert, treasury or back office function. We have never successfully pushed this timeline out materially. For lots of reasons, the lenders need to be able to jump in and sell these shares if the share price starts to deteriorate, and therefore they won't entertain extending this period because somebody's going on holiday. So it does mean that it needs to be a borrower that has a team that's able to operate this on this timetable, and it needs to be a borrower that's able to access liquidity to this timetable, because the notice period for finding cash to post as a margin is very short.
So another sort of key concern, particularly from the borrower side, is going to be your ability to release the security collateral back to you and release shares and cash from a security net. Release will usually be conditional on a lower release level, and a key point here to sort of make is that that's going to be a much lower LTV release level. So your day one LTV and your sort of trigger LTV level for a margin call are going to be much, much higher than the level you have to get to in order to release the shares back. Another key concern for the borrower is to get its hand on the dividends. Obviously, you'll sort of appreciate that one of the key tests for having a fixed charge over shares, and that was also similarly reflected in whether you have a security financial collateral arrangement over equity shares, is the treatment of dividends. So the facility agreement in a margin loan deal will usually require you to pay the dividends into a blocked account. Treatment of cash is another kind of key negotiation point. We often see lenders require not just cash to be paid into a blocked account with a fixed charge over it to be treated as eligible margin collateral for the purpose of LTV of the loan agreement, but actually a true sale and that cash to be transferred to the lender outright. Another key concern, particularly for the lenders, is they will want to restrict the ownership of the shares in the wider sort of sponsor group, and there'll be sort of two sides to this. There might be an ability for the sponsors to margin additional shares from that issuer, maybe subject to a cooperation agreement between the two different sets of lenders, and it's particularly important for the lenders in the context of enforcement and accelerated book build, where they'll want to have a level of cooperation in how those shares are sold to the market. We also did see sometimes in margin loan deals that there are free float restrictions in the loan agreements that sort of restricts the level of control that either groups in concert can have, with the concern of the lenders being the fact that a group of other owners of the issuer's shares could sell their shares at one time and sort of depress the share value. And the second side to that is institutional, government and sort of sovereign wealth owners of the shares, where they're not likely to sell the shares, it's likely to be a long-term hold, and therefore that reduces the liquidity.
And then finally, defaults and prepayments, where these loans do look different, is there will be huge swathes of circumstances which the borrower cannot control, which will lead to a default of this facility, because the lender's eye is on the equities and the issuer of those equities rather than the borrower itself. So tender offers being launched by third parties against that issuer, a delisting, a suspension from trading, solvency issues concerning the issuer of those equities, all of those things will cause these facilities to default. And if that does happen, enforcement process will be very fast. It would be almost inconceivable in a normal corporate facility that within hours and days of a default, a lender would accelerate and enforce its security. In these circumstances, a lender must do so because in all likelihood a share price is on its way down and they need to exit before that drops too far. So it does have a slightly different character in a distressed situation. So in summary, used correctly and used by borrowers that are sort of understand what they're taking on and have well negotiated documents, margin financing offers often very, very cheap money. It is incredibly flexible in terms of releasing liquidity whilst not eroding any value in an equity position. But like all things that have wonderful upsides, there are risks inherent in them. Many of these can be mitigated with careful negotiation of documents, and it is well worth speaking to advisors who see the market on these, because there are some fairly unique features to them. So with that, I will pass over to Al Watson.
Thanks, guys. Right, I'm doing the last of the webinar. I'm looking around my colleagues, and I think we've got between about 8 and 12 minutes. We can do some questions at the end. I know that one or two questions have come through to Martin separately and also to Fiona directly by email. They may go back to you at the end of the webinar. They may go back to you separately. Certainly keep on with those questions. I'm now going to turn to my first slide. I'm going to work out the kit here. So that's Louis, that's Fiona, that's not me. Mixed use development. And when we're discussing as a team about the planning angles that we could play in here, Martin and I reminded ourselves that in September this year, it'll be 25 years for me in London, which is the longest time I've ever lived anywhere. And in the 25-year period in London, in that context, it is very, very striking how mixed-use developments have changed. So the first point I wanted to make was just a kind of a reflection on market sense and feel of mixed-use developments. First of all, they're not what they were. A traditional 20th century mixed-use development might well be a bit of office, a bit of resi, and some ground floor retail or a betting shop or income generating activity. That's not enough anymore. Local authorities want more value. They want rates. Businesses want interaction with clients and customers. Residents who live as part of these mixed-use development schemes, they also expect more. But expect more of what? And this really goes to the funding angles as well around mixed-use development schemes. What are we seeing in the market which attracts funding for a scheme to be successful and to be built out and then occupied? We're going to come on to uses in a moment, but I think in overall planning legal terms, the creation of place and space and the creation of public open space but under private ownership is an example that we see in many towns and cities, and also inevitably height. The mixed-use development schemes that we're working on, whether it's promotion or funding side, they are big. They're big and bold, and the design element has become an important part of that, where you have to have good design, which costs more money. But how do you bring about these uses in new schemes? What does a new scheme look like? Well, as a team here, we do an awful lot of residential development funding work, and one thing which has come to light in the past 4 or 5 years is, as it used to be called PRS, it's now called built to rent. And my first bullet point there sums it up beautifully. the affordability indices to allow people to own their own property is off the scale, as I put there, actually into the stratosphere. And the build-to-rent model is new in the UK. It's something you see a lot in the States, France and Germany, where home ownership is not such a holy grail or obsession in those countries as it is here in the UK. But in major cities, the mixed-use schemes that we've been working on, there is an element of BTR within those schemes. Those schemes need to be high-quality design, and the smaller living areas, where predominantly these build-to-rent units are, means there has to be more amenity space within the building and in the place-making and space-making about the building. Now, the build-to-rent product has been attracting an awful lot of lending money. And there are many, many brands, Essential Living being one of them, who are in the marketplace and building up portfolios of build-to-rent units. And because it does not have a particular use class, what the Mayor of London has done, and we're seeing this begin to emerge in other cities, is that the restriction on ensuring that that scheme remains build-to-rent, the restriction is imposed by way of planning obligation, by 106 planning obligation. And there is a document tucked away back in August 2017 that the Mayor of London produced that's called Homes for Londoners, Affordable Housing and Viability Supplementary Planning Guide 2017. Now that August 2017 document, and for the planning geeks amongst us, it's page 49, that draws out 9 elements of guidance that the Mayor believes should be reflected in build-to-rent to allow it to be called build-to-rent and obtain a relevant permission. And there is one part of that 9 limbs which has been a sticking point for some developers here in London. The planning obligation, which comes with the planning permission to build out the build-to-rent from the Mayor, means that you must hold the build-to-rent block as build-to-rent for at least 15 years, which is longer than some operators have previously been looking at. And that obligation is then subject to a clawback provision, where if the developer or owner seeks to sell out of rented tenure into the market ownership tenure, there's a clawback provision. So the Mayor will take back money that you take off the profit of the deal and put it into affordable housing. That takes some assessments on the funding side and the return side, and certainly on the investment side of things, that's been a challenging assumption that some of the clients have had to get their heads around. So that's an element of what we see now in a modern mixed-use scheme. Maybe we don't call it mixed use, maybe we call it digital or multiple use, which is this slide here. When I say digital, what I mean is modern. What I mean is think positive, think logical, think ability to be flexible with space and pop-up space. For occupiers, for residents and for users, it is interesting when you see the lease structure of what the WeWork operators or other co-accommodation operators want. That's the example of a digital mixed-use development occupier. Take a look at those. They've got some great examples. Lower ground and ground floor retail units, which were big for a long time. Coffee bars, sandwich bars, retail, the market's changed radically. So having a legal agreement and having the planning permission which is able to be flexible at that ground floor activity level, pavement level use is very important. Amazon Prime lockers, last delivery units, shared space. If you go back perhaps 20 years, internet cafes were prevalent with the EasyJet chain. Well, people have the smartphones now, but to have the flexible office space, user space, which can be hired by hot desks, we've seen a few examples of those. And we've also seen and heard from developers who are willing to support local entrepreneurs by offering affordable office workspace at ground floor level. And the pop-up users point there, pop-up users, I think, is about flexibility and about reflecting the change in market demands over the course of 1 or 2 or 3 years, or maybe even by seasons, whether it's food seasons or shopping seasons. Which is why it was good to pick up on the autumn budget last year. Yes, last year, 2018, and, you know, pinch punch, first of the month, 1st of May today, and autumn budget 2018 seems a long time ago now. The autumn budget, they did produce a document at the time, October 2018, which had some ideas on planning reform, supporting the high street and increasing the delivery of new homes. That planning reform timetable has slipped. The timescale is caught up in that B word that government is obsessed with. So whilst the outcome of the consultation is not yet known, the government direction of travel is absolutely clear. They want to be able to enable owners, occupiers, developers and local authorities to have a more flexible high street, to have a more flexible multiple or mixed-use policy approach. So taking one example there, the demolition of existing commercial buildings and development as residential, that might well be a permitted development come the end of this year. So no requirement for planning permission, but levelling the old commercial buildings and bringing about residential development in their place. And that kind of more flexible approach is why I think it's nice to conclude this part of the webinar and the overall webinar itself by thinking ahead when we get together again in 6 or 9 months' time. What might multiple or mixed-use schemes look like? Because they won't look like what we're used to. So those are my slides. That's my input. The surveys you can see at the side of your screen. So do us a favour, please, all of us. We'd love to have your feedback to do better, to do more things that you're interested about. So do pick up on those survey questions. Questions we've had 2 or 3 more, but directly into Martin and also to Louis and Fiona, and I think possibly as well to Lerica. We'll deal with those offline if we make. I think we're almost out of time. So we're out of time this time, but we'd hope to see you next time. Thanks very much for joining us, and we'll see you again.